We all want some level of safety and security. Firefighters, construction workers, EMT. They're all there when you need them to help manage life's chaos. In retirement, you want that same level of safety, but who is there for you to make sure your money will last? Brian isn't just there in case of emergency. He's there so you don't have an emergency with your money. A safer retirement doesn't mean a boring retirement, but a prepared one, full of the things that inspire you. This is Safer Retirement Radio with Brian J. Decker.
Welcome to Safer Retirement Radio with Brian J. Decker and Brad Geddes of Decker Retirement Planning. You can always go to the website, deckerretirementplanning.com, to learn more. I'm Mark Elliott. Glad you're with us. Again, I start every show with this opportunity that you have. By going to the website, you can find out more about Brian, Brad, and the team. You can find out about events that are ongoing that maybe you'd like to attend, a lot of information. But there's also, under the heading, deckerretirementplanning.com, under the heading of Safer Retirement Education, there are 12 different things you can download, including Brian's book on retirement, The Decker Approach. A lot of things that are there really for your information. There's no cost. You can download any or all. It's really there for your information. Then maybe once you get some of that, maybe you read Brian's book on retirement, The Decker Approach. Maybe you have some questions. Call the team, 833-707-3030. No cost to chat with the team, 833-707-3030. Should I be moving money into the Roth world? Hey, should I be paying off my house? There's a lot of questions you may have. Can I retire? Well, when can I retire? Do I have enough? Will my money last? 833-707-3030. Brian, Brad, welcome. Brian, where are you going today?
Thanks, Mark. Want to talk about real estate from all different angles. Want to talk about cash flowing your investments, specifically real estate. And want to point out one of the big differences, Mark, between rental real estate that's been owned for 10, 15, 20 plus years, going into retirement. You've got a diversified income stream. You've got a good profit margin built up on those properties. But someone that's 65 years old and retiring and wants to add rentals, that's a different story because those properties aren't going to give you a good ROI right off the bat. They're not seasoned like someone who's owned rentals for 10, 15 plus years. So that's one of the things I wanted to cover. The next, Brad, let me give you a situation. Let's say that someone has $300,000 mortgage on their $1 million home. Let's say that the assets of person A, couple A, they have $800,000 in assets. Couple B has $3 million in assets. Now, David Ramsey, he says, pay off your debts. How do you reconcile couple A with couple B?
I mean, the paying off the mortgage is like, in terms of the Ramsey approach, it's definitely the end all be all. It's kind of the standard for retiring is going to retirement when you're completely debt free. And there's a lot of opinions on this, especially because of where I live. Home prices are pretty dang expensive, and it actually ends up occupying. It's not unreasonable for many of my clients to come through my office and they'll be living in 3/4 of their net worth. It's very common. And the question is, can I retire? Do I have enough saved up? And if you look at the full picture, the answer is a screaming yes. They have plenty of net worth to be able to live and retire comfortably. But how do you get the cash flow? And I think that's where you're going with this is where does the cash flow come from when either your home asset is occupying 2/3, 3/4 of your total net worth? It just makes it tough, makes it really tricky to actually live a lifestyle that people want.
Yeah, I would just point out, let's say I'll add additional information. Let's say they both have a 3% mortgage. That's almost free money. Why would you pay that off? In the case of couple A, $800,000 in assets, you pay off $300,000 mortgage. That's going to hurt their cash flow in retirement. So I would just say I'm a fan of Dave Ramsey, but couple A will be hurt if they pay off their mortgage. Couple B, not so much. They've got $3 million. They pay down a $300,000 mortgage. They have a 3% mortgage rate that we would probably advise them that their portfolio is returning much more than that. Why not keep a positive arbitrage? Their portfolio is earning higher than the cost of their debt. So that would be a couple things to think about right off the bat. Now, Brad, something that we see a lot, let's say that someone has in a lifetime accumulated, I don't know, $900,000 in assets. No. I'm going to make this tougher. Couple A, 65 years old, They have $800,000 in assets, and they're living in a $2 million home, and they would like over north of $10,000 net per month. What would you recommend for them as far as cash flowing their assets?
Oh, yeah, this is a tough one because, again, it's right up my alley. Where I live in the San Francisco Bay Area, I do come across this type of situation. And the answer is that there's not a lot of options, especially if the people want to stay in that home. You know, some people, it's the family home. It's the place that everybody comes and visits. And if their goal is to stay where they're at, this is why reverse mortgages exist, is to be able to provide the cash flow that is so difficult to access when people do have a large asset like that. That they sort of need, right? They're going to live somewhere and their goal is to stay there. Well, reverse mortgages end up being the solution. Not my favorite solution, not by any means the most mathematically sound solution, but definitely can work to help facilitate a retirement for those kinds of goals.
Now, Brad, we consider homes sacred. They're off balance sheet. They're not on our income plan. So it's kind of a last resort for people because a lot of people do want to pass on assets to their kids, but when they have the majority of their assets in their home equity, and if we're true fiduciaries, we are going to point out that that's an option that they can use, right?
Yeah. It's definitely an option. It's a tool. It's not an optimized option. It's not if someone is just purely math-based, how to get the best return. What it does is it helps accomplish a goal. And that goal, all goals, I think, have trade-offs to some degree. And so there's some trade-offs that have to be considered, but in some cases, it can be the very best option for them.
Okay, now here's another situation with real estate. You've got someone with a 3% mortgage, couple A, 65 years old. They both have $3 million in assets, $300,000 in mortgage debt. Couple B just bought a $3 million home. Their rate is 7%. Do you advise both of them to follow the Dave Ramsey approach and pay that mortgage off?
If they never want to retire, go for it. That would be really tough to do. And I think a couple things about that approach. It's a nice to have. It's a nice to have to not have a mortgage payment. And it's a nice to have because it means that you're leaving behind a massive legacy for kids and grandkids to be able to sell off that house and get a very large inheritance down the road. But in terms of helping someone have a lifestyle that they want to be able to live within during their retirement years, it's really hard to accomplish that goal. I mean, you mentioned that 7% mortgage. That is a huge amount of monthly cash flow that's required to finance that house. And if they're at the very beginning of that home purchase and that mortgage payment, the majority of those payments are going towards just servicing the interest, and can be very, very tricky to have a retirement happen successfully with those kinds of numbers.
I would recommend, being math-based, our firm, I would recommend that they not pay off the 3% mortgage. That's almost free money. And again, positive arbitrage. If your portfolio is earning more than the service of the debt, you're making money by not paying it off. The cost of the debt is less than your portfolio returns. So, but once you get up to 7% mortgages, we strongly advise if they can still retire. And see, being math-based, Brad, is so important because we can do the calculations and see plan A, if they do pay it off, what their net of tax monthly cash flow is. And if they don't, we run two different plans, keep the mortgage or not. We can do the math and see which one the client wants.
I agree. And that's where it's the trade-offs conversation. It's not right or wrong, especially when it's math-based. The math is neutral, and it just has different outcomes. And so this is where I think some of those maxims or rules of thumbs of do this in retirement, pay off that mortgage in retirement. Those are treated as if they're noble certainties, and they absolutely cannot be challenged. You must do that going into retirement. And I think it should be addressed with more neutral, objective discussions around, well, that's great. You want to pay off your mortgage. Let's take a look at what that costs and what the advantages of this would be. Your estate is larger. Your expenses or your cash flow out when it's paid off is lower. But at the same time, it occupies a massive amount of people's net worth and can take a lot of cash flow to get to that point. And a lot of interest. So it's a trade-off. So right, being a fiduciary, being math-based is the starting point. And then just making sure that people understand what they're giving up to accomplish one particular goal is the way to go about it.
So Brad, another point on real estate is what happens when your trust has an AB credit, an AB clause, so that when you die, there's a survivor trust that's created and a decedent trust. That's very common. But if you want to pass along real estate with a stepped up basis, that won't help you. It'll help you with the state or federal estate tax, but it will hurt you because it will negate your ability to pass real estate on with a stepped up basis. So let me say this again. This is new. It's technical. And I want to make sure that you're checking, you radio listeners are checking with your estate planning attorney on this. Check your trust. If you have an AB clause where you create first to die, creates a decedent trust and a survivor trust, which is used to get as much credit at the state and federal level as possible. That's important. But if you're passing on a lot of real estate with the hopes of passing that with a stepped up basis, check with your estate planning attorney. That AB credit will hurt your ability to pass on real estate with a stepped up basis.
So if you'd like to sit down with a team at Decker Retirement and talk about these kind of questions, boy, do I pay my house off? Do I not pay it off? I have a low interest rate. I have a high interest rate. All those kind of questions, because it all plays into, will your money last as long as you need it to? These are big decisions. Brian J. and Brad, they can certainly help sit down and walk through this situation with you. 833-707-3030. Again, this is totally complimentary. There's no cost to you. It's a great opportunity for you to get some free advice, actually. But then maybe there'll be enough ideas that the team at Decker Retirement has for you that maybe you want to sit down and let's go look at things a little bit deeper. We don't know. They don't know until you reach out. But it's an opportunity for you to get maybe some clarity into, especially, do I pay the home off? Do I not? That's a great opportunity for you there. 833-707-3030. 833-707-3030. We're just getting started on Safer Retirement Radio with Brian J. Decker and Brad Geddes of Decker Retirement. Stay with us. We got a lot to get to. Back with more right after this.
Legacy planning is more than just numbers. It's about the impact you leave on generations to come. Let Brian Decker guide you in creating a lasting legacy. Call Brian and the team at 833-707-3030 to start your legacy journey.
Who likes uncertainty? Wall Street certainly doesn't. With near record inflation and partisan politics, there's a lot of uncertainty right now. What will America's future look like? What will your future look like? Will your taxes go up? Will your savings go down? For more than 3 decades, Brian Decker has seen uncertainty come and go. No matter what the future holds, Brian and the team at Decker Retirement can help you create a plan designed to preserve your finances in uncertain times. And it's not a matter of if those uncertain times will show up, but when. Call 833-707-3030 now to meet with Brian Decker and the Decker Retirement Team. If uncertainty is causing you to feel insecure, Brian Decker can help. Call 833-707-3030 and schedule your visit today. 833-707-3030. Investment advisory and insurance services offered through Decker Retirement Planning, Inc., a registered investment advisor. Investing involves risk, including the potential loss of principal.
Have you noticed the market's roller coaster ride lately? Even a single day's dip can significantly impact your retirement. If the idea of shielding your nest egg from market volatility resonates with you, it's time to talk to the experts at Decker Retirement Planning. Call us now at 833-707-3030. Our unique approach aims to dial down the risk, keeping about 25 to 30% of your assets at risk, instead of the conventional 60-40 pie chart. At Decker Retirement Planning, we don't use a pie chart. We strive to offer you a detailed retirement income plan. It's about seeing the bigger picture, aligning your investments to your long-term goals, and making informed decisions. Whether you're new to retirement planning or already have a plan, we can help. Call Decker Retirement today to learn about the 6 things we do well for our clients that all financial advisors should be doing. Call 833-707-3030 today. That's 833-707-3030. Investment advisory and insurance services offered through Decker Retirement Planning, Inc., a registered investment advisor.
You're listening to Safer Retirement Radio. If you like what you hear on today's show or have questions, drop by DeckerRetirementPlanning.com or call 833-707-3030 to talk to Brian.
Welcome back to Safer Retirement Radio with Brian J. Decker and Brad Geddes of Decker Retirement Planning. Again, you can always go to the website to learn more, DeckerRetirementPlanning.com, DeckerRetirementPlanning.com. Offices are in Washington, California, Utah. The team is here to help you regardless of your situation. How can they help? Boy, I wonder if I can retire. I think I've got enough. Well, why not find out? Talk with the team. They're here to help. Do I sell the home? Do I not pay off the home? How do I figure all of that out? It's a big part of retirement as well. Big chunk, maybe your retirement would be the value of your home. But how do you turn that into cash without selling it? Well, that's a little challenging. But do you sell it? Is that the right decision? There's a lot of questions that people have. And Brian and Brad and the team at Decker Retirement are here to help you. 833-707-3030, 833-707-3030. Totally complimentary to talk with the team. I'm Mark Elliott. Glad you're with us. We're going to go from the real estate world to the healthcare world. Brian, long-term care is one of those, when you think of Fidelity, they do this study all the time. The average 65-year-old healthy couple will need, and 10 years ago, it was about $220,000 out of pocket for health care, not including long-term care. Well, that number by Fidelity has now risen to $315,000 out of pocket for the remainder of your life for a healthy 65-year-old couple, not including long-term care. Those are crazy, crazy numbers. But if you're retired for 30 years, I mean, it'd be a little over 10 grand a year, I guess, so it's possible. How do you look at long-term care? Because I think a lot of people think, well, Brian, when I get to 65, I've got Medicare. I'm good.
We're going to put Brad in the hot seat because he's so smart. He's a CFP. We're a math-based firm. And Brad, the definition of long-term care is the risk of becoming bankrupting a spouse because of healthcare costs. So, Brad, let's start with the single person. If someone is single, by definition, they don't have long-term care risk of being bankrupted by a spouse's healthcare costs. What do you recommend in the case of single retirees for long-term care?
Yeah, wherever possible, that self-insuring or trying to find some way to be able to cover those costs that happen well down the road is definitely my preferred approach. And I've found that, when you look at the long-term care costs through a little different lens, like you were just saying actually perfectly, which is that the risk is not that they end up in long-term care. It's the real risk of long-term care is that there's a surviving spouse or a surviving individual that the individual had hoped assets would be passed on to. So think about it as like children, where the parents wanted to leave money behind. If they go into a long-term care situation, then there's less to pass on to kids. So long-term care, while there is the individual that is insured if they go into a long-term care facility, the real beneficiaries of the policy is not the insured, it's the recipient of the funds that didn't have to go towards it. So with a single individual, just as you said, I try to find some other way to be able to self-insure. I think the first one starts with making sure that their income is going to be stable and consistent, even if they did end up in a long-term care facility. And oftentimes they have more than enough to cover the costs of a good, if not amazing facility, to be able to pay for that out of pocket and just draw from their planned source of assets to be able to have that retirement. But then, of course, you have other aspects of people's retirements that you can usually factor in, not least of which is the real estate conversation we had just a few minutes ago, where that home asset can act as an enormous safety net under some circumstances for people to be able to pay for long-term care via a house that they no longer have need for. So self-insuring is definitely the approach that I try to pursue, especially with single individuals.
Let's talk about that number, that scary number. 70% of Americans will spend time in a long-term care facility. We had an interesting comparison of facts. Looks like the census, the U.S. Census, says about 16% of Americans spend time in a long-term care facility. And so by drilling down a little bit more, we found that by their definition, anyone who spends at least one day in hospice is in a long-term care facility. And since hospice these days comes to your home, that's why the number is so inflated. So when we get to the actual percentages of Americans who actually spend time in a facility at $10,000 a month, that number is quite a bit lower, probably around the U.S. Census number of 16%. Brad, let's talk about the different options that people have. You mentioned self-insuring. We're going to cover that at the end. By far the biggest is traditional long-term care. Can you take us through advantages, disadvantages of traditional long-term care?
Yeah, traditional long-term care is very much like the term life policies that people get when they're younger. It's like that because it's a situation where you're willing to take on or absorb the expense, but you're really hoping you don't need the benefits of that policy in the future, right? You kind of need it in case something does happen, and it's very financially prudent to have that so that loved ones aren't impacted by someone passing away. And traditional long-term care is just like that. It's an expense that you expect to take on all the way through your 60s and into your 70s and into your 80s, and it'll pay a pre-established amount in the event of needing access to those funds for long-term care. If you miss a payment or if you stop making payments, then that is a sunk cost, and you no longer have the benefit of the long-term care from that point on. So to me, with traditional long-term care, you really are in it for the long haul. You don't want to be in a situation where you make it through your 60s, you've paid $2,500 to $5,000 a year every single year, and by the time you get to the 70s, you're like, oh, it's a little too expensive now. I'm gonna back off. I'm not gonna pay this anymore. The cost, they just want to make sure they keep the costs as a part of your budget for the long run, and not just carry it through your 60s and then decide at 70 that it's not a cost that you want to carry into your 70s and 80s when you start to get to those more at-risk years.
Okay, Brad, long-term care premiums are called guaranteed level premiums. Are they? What happens to your premiums when you get into your late 60s, early 70s?
Yeah, it's a tricky one that unfortunately I have come across. When long-term care salesmen are setting up a policy, unfortunately, they sort of might realize that in some cases that people don't fully understand the contract, and they'll use the term guaranteed level premium, which is an accurate statement. But essentially what they're referring to is that you'll have the option to maintain the same amount every year. But what they fail to elaborate on is that doesn't guarantee that you have the same level of benefits. And so as you start to get to your late 60s, 70s, what can happen is they'll send you a letter and you open it up and they'll inform you that you have the option to, as guaranteed, pay the same amount of premium. But they're going to let you know that they're going to be reducing your benefits. So you get to these more at-risk years and you have this really tough situation to be in. You either have to pay them more money to maintain the benefits that you signed up for originally, or you can pay the same amount, but they're going to be cutting your benefits in half. So kind of a lose-lose situation there between whichever option you want. But yeah, I don't like that guaranteed level premium. I think that the wording of it isn't how people expect it to be.
Now, also on traditional long-term care, Brad, there's an age where it doesn't make sense to start it. What is that cutoff age where, like term life insurance, you get your great monthly benefit, which was so good, all of a sudden becomes exorbitantly expensive? What's the cutoff that you use for people with traditional long-term care?
It's not a hard cutoff, but I think when people start to get into their 60s, it's probably best to look for something else than just the traditional long-term care. That's where you have to. It is a very, very steep expense to carry all the way through your 60s for a policy that you might not even ever need in the future. So I think if someone's in their 50s, totally reasonable to go and get educated and poke around and see if it's something that makes sense for you and your family. But I think when people start to get into their 60s, certainly nothing later than 65. But I think, 50s are the time when you want to explore long-term care very seriously if you are expecting to maintain that cost forever. As you start to get into your 60s, it becomes less and less of an opportunity.
Brad, anything else on traditional long-term care you want to talk about before we cover some of the others?
No, I mean, there's a lot to unpack with long-term care. I think if people understand that primary fact that the long-term care insurance, while it would be used to cover that individual's expenses in long-term care, the actual beneficiaries are the ones that are going to survive the person that is entering long-term care facility. So specifically in the case of spouses. So it's the surviving spouse that you are providing insurance for. That's what you need it. So as people understand that, it gives a good frame of reference for how to proceed with a long-term care strategy.
Well, in the next segment, we're going to talk about the other options for traditional long-term care. And some of them sound really good, but we're going to unpack them, talk about the advantages and disadvantages of whole life with a long-term care rider, the Safe Harbor Trust. We'll talk about the different options you have, and we're going to spend a lot of time on self-insuring that risk.
So that's all ahead right here on Safer Retirement Radio with Brian and Brad. Again, if you have questions about this, think of this stat. 67% of all bankruptcies come, whether you're working or retired, from medical bills. So you've got to have a plan during your working years, and obviously even in retirement. You need a plan for this. We all know Grandma would do everything she could to make Grandpa as comfortable as she can towards the end with no regard to herself. Well, Brian and Brad and the team at Decker Retirement want to make sure Grandma's going to be okay too. You got to have a plan. 833-707-3030. No cost to chat with the team. 833-707-3030. All right, more on long-term care. What are some of those options that Brian and Brad will talk about? Stay with us and find out. This is Safer Retirement Radio.
In the world of taxes, knowledge is power. Let the team at Decker Retirement Planning empower you with the insights and strategies needed to navigate the complexities. Dial 833-707-3030 to stay ahead of the tax game.
Who likes uncertainty? Wall Street certainly doesn't. With near record inflation and partisan politics, there's a lot of uncertainty right now. What will America's future look like? What will your future look like? Will your taxes go up? Will your savings go down? For more than 3 decades, Brian Decker has seen uncertainty come and go. No matter what the future holds, Brian and the team at Decker Retirement can help you create a plan designed to preserve your finances in uncertain times. And it's not a matter of if those uncertain times will show up, but when. Call 833-707-3030 now to meet with Brian Decker and the Decker Retirement Team. If uncertainty is causing you to feel insecure, Brian Decker can help. Call 833-707-3030 and schedule your visit today. 833-707-3030. Investment advisory and insurance services offered through Decker Retirement Planning, Inc., a registered investment advisor. Investing involves risk, including the potential loss of principal.
Have you noticed the market's roller coaster ride lately? Even a single day's dip can significantly impact your retirement. If the idea of shielding your nest egg from market volatility resonates with you, it's time to talk to the experts at Decker Retirement Planning. Call us now at 833-707-3030. Our unique approach aims to dial down the risk, keeping about 25 to 30% of your assets at risk, instead of the conventional 60-40 pie chart. At Decker Retirement Planning, we don't use a pie chart. We strive to offer you a detailed retirement income plan. It's about seeing the bigger picture, aligning your investments to your long-term goals, and making informed decisions. Whether you're new to retirement planning or already have a plan, we can help. Call Decker Retirement today to learn about the 6 things we do well for our clients that all financial advisors should be doing. Call 833-707-3030 today. That's 833-707-3030. Investment advisory and insurance services offered through Decker Retirement Planning, Inc., a registered investment advisor.
Glad you're with us today for Safer Retirement Radio with Brian J. Decker and Brad Geddes of Decker Retirement Planning. 833-707-3030. If you have questions, you have concerns, I think I've got enough. I hope we've got enough. I don't know. Can I retire? Well, when can I retire? Will money last as long as we need it to? A lot going on when we get to that retirement world. It's on our shoulders, where our grandparents pretty much had things taken care of, at least income-wise, pension, Social Security. A lot of times their employer would take care of their health care, didn't think they'd be around that much longer. It's different in our world today. So the team at Decker Retirement here to help you figure out where you are on that road to retirement. 833-707-3030, 833-707-3030. All right, you're talking long-term care, Brian, you and Brad. You got some other areas you talked about self-insuring, then you talked about the old long-term care policies. Still, some of those make sense sometimes, but typically premiums will go up the closer you get to probably when you need it. So there's some challenges there, but there are some other options.
Yeah, one more thing about traditional long-term care, which we covered in the last segment. You need to know that the letter is coming. In your late 60s, early 70s, you're going to get the letter that says that your monthly premiums that are titled guaranteed level premiums, they're not. You will get a letter saying that your guaranteed level premiums have gone up 60%. That's the state's limit. That happens. You can count on it, bank on it. And what they hope you do is that you cancel, saying it's too expensive. Don't do that. If you have traditional long-term care, you know that you've got to know that this is coming. Second, we hope you don't cut the premium in half, because then for the same, you're getting half the benefit for the same price. And third, what we hope you do is know that it's coming, it's part of it, and budget for it so that you can ride it through. But the letter is, you need to know that with traditional long-term care, that letter is coming in your late 60s, early 70s. Okay, Brad, let's talk about asset-based long-term care as an option, advantages and disadvantages for long-term care.
Yeah, the asset-backed strategy that I tend to prefer, that's going to vary from person to person, and insurability is super important here. The one reason I like this one is because I think it does a lot better job of being able to have flexibility on what you use that policy for in the future. Because if you have the one where it's just a monthly or annual payment to a long-term care insurance company, if you don't use it, thank goodness you never needed it. How wonderful. But you did end up paying a lot of money out for funds that you wish that you could have kept. And so with asset backed, you're able to keep at least a balance of those funds as you're paying into it. And you can apply that. You get 2-3 times whatever is in the policy at the time that you actually need to use the long-term care component of it. So I think it's a better one, gives people the option to cancel a policy in the future if they wanted to, or if they don't need it, the value of that policy goes on to beneficiaries as a tax-free death benefit. So it's a better trade-off of risk and reward when you go with that asset-backed approach.
Now, let me say what you just said, Brad. If I own traditional long-term care as a solution for long-term care risk, if I die of a heart attack, or if I die of a stroke or car accident, whatever, that money's gone. But with at least the asset-backed long-term care option, you get a certain payout if you die. You get a different payout if you go into a facility. So you're going to use that money either way. So what is the negative to that? The insurance companies have to make a profit on that. So what is the negative, and how do they make a profit on that, on the asset-based long-term care?
The asset-based. Yeah. So the primary advantage of asset-based or asset-backed long-term care is that you have a certain amount of your principal that you've contributed to this policy that is no longer an expense. You're building up an asset. It is building up a piece of your total net worth that is going to be used by someone at some point in the future, guaranteed. It's either going to be used by you because you cancel a policy, you get your money back, you decide I just have better uses for this, or I no longer need the long-term care coverage that I originally thought I might want to protect against. Or it goes towards your beneficiaries in the future. In this situation, you don't use it. So it stays within the estate, wasn't an expense, thank goodness. It was never needed. It goes on to the loved ones. Or it's used for its intended purpose, which is that it helps cover the costs that you incur through long-term care. Now, the disadvantage of a long-term care policy that is asset-backed is you're not looking for a return here, right? You're looking for a place that is going to return the value that you've added to that policy, or at least most of it, if you don't end up needing it in the future. So your rate of return on these funds that are parked are not going to be as high as if they were just invested elsewhere in more traditional assets. So you might end up 3%, 4%, 5% annualized returns. And while that, depending on the market environment, might be an attractive fixed income type of yield, but the insurance company will be making money on the difference. So they will likely have it invested in a way that produces a higher yield than 3%, 4%, 5% per year. So you get a little lower yield than what you would have done if you had just taken those same amount of dollars and parked them in a portfolio that you were managing for the long haul as part of your estate, like the rest of your financial assets. I think the last drawback of the long-term care, the asset-backed long-term care, is sometimes they can be less efficient. You might have put away $100,000 into the policy, and maybe you'll get $200,000 of coverage, versus if you were paying in for a lifetime through the term style, the annual expense style long-term care. There's usually, I've found, more leverage there, at least when people are in their 50s and 60s. That leverage goes down a lot as you start to get into your 70s, and you can have those payments increase in the future. So all said and done, I think self-insuring is definitely my preferred when a client can. But in situations where they do want to mitigate this risk with financial strategy, with insurance, I do prefer the asset-backed long-term care, because it just provides more flexibility for the unknowns around how life is going to, what cards life is going to deal them in the future. And I think that asset-backed gives you a lot more flexibility in the case where you may or may not need it in the future.
So Brad, to self-insure, what kind of money are we talking about? I mean, these are crazy dollar amounts, aren't they?
Yeah, I mean, it can be expensive, definitely. And the thing that I've found in my office is that everyone, by 1 degree of separation, has a sense of how expensive it can be. It can be someone's mother, mother-in-law, friend, family member of a friend. Usually people have a general idea via personal experience with how expensive it can be. The thing, though, that I found is that the monthly number can be stark. You can have, up the street from me, there's one that's $15,000 a month. That's $180,000 a year. You get 2 years in a long-term care facility. That's a big chunk of change for most retirees to be able to just self-insure. But, that said, there's a lot more to it than that. Not all facilities are $15,000 a month. There's some, Brian, I think you mentioned a client that we had in the past that was in Spokane, Washington. Lovely place to live. Maybe not everyone's ideal spot to retire to, but much more affordable healthcare in that city than if it were, in say some major metropolitan area. So I think the monthly sticker shock sometimes catches a lot of eyes. But at the same time, if we were to look at the stats of how often someone has a 2-year stay in long-term care, people will realize that a monthly number is scary, but the number of months that someone is expected to live in the long-term care facility is not year after year after year after year after year. If you're at a long-term care facility and you qualify for long-term care benefits, it is not meant to be an exceedingly long stay. It can be. There absolutely are scenarios where people do incur very large expenses, but by the numbers, it is not as scary or unattainable for many people to self-insure, especially if they have either a high level of good cash flow, good income coming in, that when they're in a long-term care facility, they just redirect that from all of their other bills and budgets and travel expenses into their long-term care costs, but then also being able to self-insure with things like home assets, real estate equity that we talked about at the beginning of this show that can actually be quite substantial.
But Mark's right. He's got a point that the high cost of this option, asset-based long-term care, it does take a lot of people out. They don't have the money to do that. Brad, talk about the misconception with long-term care. If someone is accepted in a facility and they run out of money during that period, they're not booted out. State law keeps them from doing. There's a consumer protection laws that keep people from being thrown out on the street. There's an actual review that takes place by the financial committee of the long-term care facilities where they make a financial guess because they get your Social Security, they get any income that's coming into you. They know that, and they look at the amount of assets you've got, and they make a financial decision how long you're going to live. And if you've got assets, if they take you in, they are not going to kick you out. That's a financial commitment that can't be broken. Brad, let's quickly talk about another option, which is the guy who comes up to you and says, "Hey, Brad, if you get hit by a car, hit by a bus, the proverbial bus, and you lose the traditional long-term care benefit, tell you what I'm going to do. I'm going to give you $300,000, which is your benefit of traditional long-term care, in a whole life policy, and we'll put a long-term care rider on it, so you get that $300,000 either way. Here's the catch. They price it such that in an average mortality, you're paying in most cases, this is their profit margin, more than $300,000 benefit. So watch out, because that's very, very expensive option. It sounds good on the chalkboard, but actuaries price it so that many times you will pay in more than your actual benefit.
So again, if you have questions about any of this, or maybe you have questions about all of that, boy, can we afford to self-insure when it comes to long-term care? And you go back to that stat that's 67% of all Americans that have to file for bankruptcy, it's medical bills, the number one reason. So there's a lot of challenges in this area. We don't know what's going to happen. So do we do the original long-term care, use it or lose it? Don't really like that one, but maybe that's the right play. Don't know. It's an opportunity for you to find out more. Talking with the team at Decker Retirement Planning, 833-707-3030, 833-707-3030. This is a big deal, and especially if you've had anybody in your family you've had to deal with this, I think you get it. If you've not, maybe you're like, I'm never going to have to deal with that. Well, you don't really know. So the idea is talk with a team that actually works in the retirement planning world, like Decker Retirement Planning. Find out more. Find out those options. Make the right decision for you and your family. 833-707-3030. Back with our final segment of Safer Retirement Radio with Brian and Brad right after this.
Crafting your legacy is like planting seeds for a future forest. Let's nurture your vision together. Speak with Brian and the team at Decker Retirement Planning at 833-707-3030 to ensure your legacy grows strong.
Have you noticed the market's roller coaster ride lately? Even a single day's dip can significantly impact your retirement. If the idea of shielding your nest egg from market volatility resonates with you, it's time to talk to the experts at Decker Retirement Planning. Call us now at 833-707-3030. Our unique approach aims to dial down the risk, keeping about 25 to 30% of your assets at risk, instead of the conventional 60-40 pie chart. At Decker Retirement Planning, we don't use a pie chart. We strive to offer you a detailed retirement income plan. It's about seeing the bigger picture, aligning your investments to your long-term goals, and making informed decisions. Whether you're new to retirement planning or already have a plan, we can help. Call Decker Retirement today to learn about the 6 things we do well for our clients that all financial advisors should be doing. Call 833-707-3030 today. That's 833-707-3030. Investment advisory and insurance services offered through Decker Retirement Planning, Inc., a registered investment advisor.
You're listening to Safer Retirement Radio. If you like what you hear on today's show or have questions, drop by DeckerRetirementPlanning.com or call 833-707-3030 to talk to Brian.
Glad you're with us today for Safer Retirement Radio with Brian J. Decker and Brad Geddes of Decker Retirement. Again, you can always go to DeckerRetirementPlanning.com to find out more about Brian, Brad, and the team. You can also find out about questions that you may have about retirement, because there's a lot of things you could download. There's a heading on the top of Decker Retirement Planning. When you go to that website, Safer Retirement Education, you can get Brian's book on retirement, The Decker Approach. You can get 3 Principles of Retirement book, Checklist Challenge, Sample Income Plan. That's just 4 of the 12 things you could download from that Safer Retirement Education site on Decker Retirement Planning's website. It's a great opportunity for you to learn more, maybe about different areas of retirement. Maybe the great place to start is just Brian's book, The Decker Approach. So a lot of opportunities for you to learn more. And if you have questions, you can always call the team. You have questions right now about retirement, 833-707-3030, 833-707-3030. All right, you guys are discussing long-term care, the options. There are options, and I think that's really kind of what you guys do, whether it's in the market world, the insurance world. There are a lot of tools. There's just no silver bullet. You have this tool, you're good to go in retirement. That's not the case. So options are kind of the idea of the day, I think, today, especially when it comes to long-term care. A lot of options. One of those might be right for you. One of those might not be right for you, right? So, I mean, it's kind of, you need to sit down with your clients, Brian, I guess, and you and Brad, you talk to them about it, and you try to figure out, okay, well, this option makes sense for you. That one doesn't so much. That's kind of what it is, isn't it?
Yeah, I think so. There's a couple other options that want to make sure that people know about. One of them is kind of funny, Mark. Brad, you've heard of the Safe Harbor Trust. I'm going to try to go through this one. Safe Harbor Trust is where I'm married to Diane and I say, Diane, geez, 70% chance that we're going to spend time in a long-term care facility. I got a great idea. Let's use a Safe Harbor Trust, transfer assets over to my brother, Brad. And I don't know, if we ever need the assets back, we'll pull it from Brad. But that way, if I get sick, then I can go on Medicaid, taxpayer expense. And then when I pass, sweetheart, you can pull the assets back. That is called the Safe Harbor Trust. Well, the advantage of that is, I guess, chalkboard logic only. The disadvantage is Brad can call us from Cabo a few weeks later and say, hey, Brian, thanks for the assets you gave me, because they're legally his. And the IRS has a 5-year clawback provision. If you're diagnosed with anything that would make it look like you're terminal and you're going to pass away soon, there's a 5-year clawback provision. So not a smart move. Brad, anything you would add to the Safe Harbor Trust before we go to the very saddest option next?
No. Yeah, nothing to add. You described it exactly right. I think it's just one of the very rare ones. I don't know that I've ever actually seen that one employed in my office. I know it's conceptually something people have done for very strategic reasons, but it just is laden with risks. You have to trust the individual that's receiving them. There's the clawback. It's kind of a messy one, and I feel like it's just not a super common one to use, but it's good to know the advantages and disadvantages of, I guess, all strat.
Okay, here's the saddest one. And it kind of, a portion of this came out. Well, we have a saying that if you can afford long-term care, you don't need it. And if you need it, you can't afford it. And we see that played out. So people that might have under 500,000 in assets, or maybe under 300,000 in assets, and one of the spouses is diagnosed and it gets into the very expensive period, some spouses, to financially survive, have to divorce. And that is a heartbreaker. Brad, anything you'd add to that before we spend the rest of the segment talking about why and how and sources of income to self-finance that risk?
No, let's dive into that, because that latter one is where I think good financial planning can help alleviate a lot of those concerns. It's very, very terrifying for people to enter their 60s all excited about retirement, but then to have this lingering fear that they might end up having these outsized healthcare concerns down the road. And that's why self-insuring is definitely my primary recommendation at this stage in the game. So that's what I'm excited to talk about today.
Okay, good. So here's what I say to people to self-insure their risk. Typical client, I don't know, mid-60s, married, 1.2 million in assets. They start out in retirement, and we have for their retirement portfolio a couple of ways that typically they can look at a worst case scenario. By the way, worst case scenario, that would be a triathlete body with Alzheimer's. That diagnosis is a killer. If they're married, the first third of the journey doesn't cost them financially. Emotionally, it does, but one spouse is being cared for by the other spouse. The second part of that journey, it's in home care. It starts a couple thousand a month and goes up from there as care is needed. The third of this journey is a couple years, and that is where one spouse dresses up for meetings, wanders out at night, endangers himself, and so he's checked into a full care facility at $10,000 a month. Well, $10,000 a month, 2 years, 24. Let's bounce it up to $300,000. That's why typical long-term care benefits, where they go at $300,000. Now, remember, it takes a while to get to this point. So in the 10 or 15 years that you're into retirement, you've got your two ways that you can that you can financially cash flow this cost, a worst case scenario of $300,000. One is the risk bucket that we have for our clients. The managers we're using are averaging much higher than the bogey that we use. We use 6%. So there'll be extra that builds up over 10 to 15 years where they will have more than the $300,000 and they can self-finance that risk. Typically, a second option is a HELOC to access $300,000 in equity from their home. They can finance a worst case scenario two different ways, typically with the clients that we see. Brad, what else would you add to that?
Yeah, just one more. And this is where the audience doesn't have the benefit of looking at one of our income plans. And I think one of my favorite things to do with our income plans is to point out to folks at ages 83 and 84 how much they still have in their portfolio. We're talking about their financial assets, their money, basically their portfolio of investments. And if you go to age 83, 84, it's a really good proxy for how much do we have in the event one of us ending up in long-term care. And it's very common to scroll over to that side of their income plan and show them that they have more than enough to comfortably self-insure quite a few years of long-term care for one of the spouses and still have enough for the surviving spouse to be able to live comfortably. So it's planning out how that portfolio with very realistic conservative return expectations will perform to both give them the cash flow that they need early and often to be able to live the life that they saved for, but then also do so in a way that by the time they do get to that more critical era of their health expenditures, that they're going to have plenty to be able to funnel towards that expense. And I'll just say one more thing on this is that especially in the case of like a single individual, when you go and you look at that column that states how much they're likely going to have left under an array of very conservative assumptions, if someone's in a long-term care facility and they're self-insuring and they're 78, 82, 87, when you plan all the way out to age 100, like we do, we go all the way out to age 100 for every one of my clients. Well, if someone's in a long-term care facility when they're 85 years old, they are not going to be living until age 100. Right. And so you could bring forward a lot of those assumptions of regular, sustained, inflation-adjusted cash flow and say, look, there is going to be a very large chunk here that is budgeted for expenses all the way through your 100th birthday that you will not need in the event of a long-term care stay sometime in your 70s or 80s.
Hey, Brad, anything else on real estate, how to use it, how to cash flow it, anything else on long-term care?
Yeah, I think there's one. It's less common, but when it works, it can work really well. And what I've found is that over the years of working with folks that are entering this new stage, this distribution stage or retirement stage of their financial life, they start to graduate beyond what they needed or what they did to get them to that stage. And oftentimes with people that, not often, but in some cases, I'm working with people that are starting to move into retirement and they're like, I have these old life insurance policies. They've got some cash value built up in them, or my grandfather gave it to me when I was born and it's done really well. But, my kids are all through college. They're all off working. Our home's paid off, as we talked about early on. What do I do with this? And that's where you can start to do some creative things with old life insurance policies. By doing a 1035 exchange, you can repurpose or reallocate those funds without a tax consequence and allocate it to something that's more appropriate for this new stage of life. When you're in your 20s or 30s and you're looking into life insurance policies and maybe you get a whole life or a universal life, you're not usually thinking about long-term care at that stage. You're thinking about maximizing your death benefit. Well, when you enter your 60s or 70s, might be a good time to dig out those old cash value policies that have essentially run their course. And you can look at possibly retooling that to get a benefit that's more appropriate for the stage of life that you're in. Specifically in this case, maybe adding in, taking out a new policy that's more efficient for long-term care concerns or inflation adjusted long-term care concerns if inflation is one of your main concerns. So you can take a look at those old policies. Don't ignore them. Just because they've run the course of your original goal doesn't mean that they can't be possibly redirected to something that's more appropriate for the stage of life that you're in now.
So when you think about long-term care, there are a lot of options. Hopefully we never need it. That's certainly number one. But people that need it. My mom's in long-term care facility right now in assisted living. It's a challenge. The price jumped way up from the old unassisted living cost, that's for sure. So there's a lot of challenges here. The idea is, let's look at what you've got. What do you think you need? And then how do we help? And the team at Decker Retirement is certainly here to do that for you, to walk you through the options. Now you're making an educated decision. You're not guessing. You're not hoping that this works. You actually know that it will work. 833-707-3030. Again, there's no cost to chat with the team at Decker Retirement. There's no pressure. There's no obligation. There's no judgment either. The decisions are yours. It's your retirement. It's your money. It's your hopes and dreams. How can the team at Decker Retirement make that even better for you and give you more clarity? More, I think, just being comfortable with, yes, we can take that trip. Yes, we can get that new car. No, we should wait on that. Don't really know. Why not find out where you are? No matter whether it's income, investment, taxes, healthcare, legacy planning, Social Security, Medicare, all those decisions you have to make in retirement. Brian and Brad and the team at Decker Retirement are here to help guide you. Again, that number, no cost to chat with them. 833-707-3030 is the number, 833-707-3030. Enjoy the rest of your weekend. Brian will be back, maybe with Brad, next week, right here on Safer Retirement Radio.
Security and insurance services offered by Decker Retirement Planning, a registered investment advisor with the SEC. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This radio show is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual's situation. Decker Retirement Planning is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein, provided by third parties, have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Decker Retirement Planning. This radio show is a paid placement.
Who likes uncertainty? Wall Street certainly doesn't. With near record inflation and partisan politics, there's a lot of uncertainty right now. What will America's future look like? What will your future look like? Will your taxes go up? Will your savings go down? For more than 3 decades, Brian Decker has seen uncertainty come and go. No matter what the future holds, Brian and the team at Decker Retirement can help you create a plan designed to preserve your finances in uncertain times. And it's not a matter of if those uncertain times will show up, but when. Call 833-707-3030 now to meet with Brian Decker and the Decker Retirement Team. If uncertainty is causing you to feel insecure, Brian Decker can help. Call 833-707-3030 and schedule your visit today. 833-707-3030. Investment advisory and insurance services offered through Decker Retirement Planning, Inc., a registered investment advisor. Investing involves risk, including the potential loss of principal.